Right now, a cargo ship stuck in the Middle East is secretly deciding the price of your next Louis Vuitton bag.
Yeah, it's pretty wild.
Right. And today, April 13th, 2026, we are breaking down the bizarre chain reaction that makes that possible. I mean, when you look at the global dashboard right now, you're looking at a wild, almost unprecedented mix of geopolitical shockwaves and massive tech realignments.
Absolutely. We're watching forces that usually operate in, completely separate universes like military conflict, artificial intelligence, and high fashion suddenly colliding and rewriting the rules of the market.
Which is why our mission for this deep dive is to cut through the absolute wall of noise out there.
Hmm?
We've got our hands on today's comprehensive daily market briefing, and we're going to figure out how this international conflict, a rapidly shifting web of AI alliances, and honestly, a truly paradoxical slate of corporate earnings are shaping your financial reality.
There's a lot to cover.
So much. We are going to map the heavy geopolitical factors first, then explore why Wall Street is punishing companies for breaking records, and finally, look at a massive software rally that is just, well, it's defying gravity entirely.
Yeah, the through line here is really understanding how modern markets digest chaos and, more importantly, how they often completely misinterpret it.
Okay, let's unpack this. Think of the global economy like a massive game of dominoes. A conflict in the Middle East is the first domino, and somehow the final domino falling is someone's power grid going out in California.
Right.
Let's get right into the macro web. The foundation of today's market mood is the U.S.-Iran conflict, specifically the dramatic plunge in Middle East oil production.
Yeah, the U.S. has imposed a blockade in the Strait of Hormuz, and looking at the math behind this blockade, if we remove the politics entirely, the numbers show a massive bottleneck.
Now, wait, real quick. Before we dig deeper into this, we need to pause and make something incredibly clear to everyone listening.
Yes, absolutely.
We are impartially reporting the contents of the daily market briefing regarding the U.S.-Iran war, the U.S. blockade in the Strait of Hormuz, and President Trump's tariff threats. We are not endorsing any political viewpoints here.
Right, we are simply conveying the facts from the source material. No taking sides, just looking at the data.
Exactly. So back to the Strait of Hormuz, you said it's a bottleneck.
Oh, it is arguably the most critical choke point for global oil transit. It's the main artery. When the Strait of Hormuz freezes, the global energy market essentially goes into cardiac arrest. It is a severe supply shock.
Wow. But here is where the market mechanics get confusing for me. If there is a major military conflict and a literal oil blockade, shouldn't panic be driving interest rates up? Instead, we are seeing treasury yields like edging lower today.
I know, it's a classic counterintuitive market mechanic. When geopolitical tension spikes, investors panic and look for the safest place to park their cash, which is typically U.S. government bonds.
Right.
So demand for those bonds skyrockets.
Wait, if demand for bonds goes up, shouldn't the yield go up?
It's actually the exact opposite. Bond prices and bond yields have an inverse relationship.
Okay, you're going to have to explain that.
Sure. Think of it this way. A bond pays a fixed amount of interest, right? If massive demand pushes the price of that bond up, that fixed interest payment now represents a smaller percentage of your new higher purchase price. So the price goes up, the yield edges lower.
Oh, I see.
Yeah, investors are aggressively buying up that safety while simultaneously betting that the sheer economic pressure of this tension will force a diplomatic U.S.-Iran deal sooner rather than later.
Okay, let's look at how that pressure travels. I used the domino analogy earlier, but think of the global supply chain like a massive waterbed.
Oh, waterbed. I like that.
Yeah, you push down hard on the oil supply in the Middle East, and the pressure immediately pops up in the form of an energy grid crisis in California.
Right.
How does a localized blockade halfway across the world threaten to turn the lights off in Los Angeles?
Well, it comes down to a vulnerability in California's grid known as the duck curve.
The duck curve.
Yeah, California relies really heavily on solar power during the day. But when the sun goes down, which forms the neck of the duck on a graph, solar drops off right when everyone gets home and turns on their appliances.
Right, everyone's turning on their TVs, running the dishwasher.
Exactly. So to meet that sudden, massive spike in demand, the state has to instantly fire up natural gas plants or import energy.
And because the Middle East is locked down, Europe and Asia are panicking and buying up all the spare natural gas and alternative energy on the global market.
Bingo. California is suddenly forced into a hyper-expensive, supply-constrained global bidding war just to bridge its evening energy gap. A local conflict creates a global scramble for alternatives.
Man. And speaking of a global scramble, we have to factor in the other Massive geopolitical hammer dropping today. President Donald Trump is threatening a 50% tariff on China, following a report suggesting plans for a Chinese arms shipment to Iran.
Yeah, that's huge.
A 50% tariff isn't a minor policy tweak. That is a sledgehammer to international trade.
It injects a paralyzing level of uncertainty into the global economy. I mean, if you are a company relying on Chinese manufacturing, you are suddenly looking at a potential overnight cost increase of 50%.
Which you can't just lead.
No, you can't just absorb that. You pass it down to the consumer, which immediately drives up inflation.
Which puts the Federal Reserve in a terrible spot because they are already trying to balance inflation and growth.
Exactly. Which is why the market is paying very close attention to an otherwise mundane administrative detail today.
Oh, the paperwork thing.
Right. Fed nominee Kevin Warsh just cleared a major hurdle for his Senate hearing by submitting his required ethics paperwork.
In normal times, paperwork wouldn't move the needle at all.
Not even a blip.
But in this environment, with wars, blockades, and 50% tariff threats, the market desperately needs a fully staffed, fully operational Federal Reserve to navigate the incoming inflation shock.
Stability is at an absolute premium right now. The market is desperate to know the adults are in the room and ready to act.
Okay, so we have this intense macro web. How does a blockade and a tariff threat actually hit corporate bottom lines?
Let's look at the numbers.
Let's pivot from the geopolitical theories to hard earnings data, starting with the luxury sector. LVMH, the massive conglomerate behind Louis Vuitton, Dior, Moet, they missed their sales expectations.
They did.
And the briefing explicitly links this to the luxury sector's recovery being put, quote, on pause amid the Middle East war. I buy the travel disruption angle, but are you really telling me billionaires check their stock portfolios before buying a handbag?
Well,
Isn't luxury supposed to be recession-proof?
what's fascinating here is that you'd think so, but the psychology of the high-end consumer is surprisingly fragile.
Really?
Yeah, it operates on something called the wealth effect. It's not about the cash in their checking account. It's about how rich they feel on paper. When there is severe geopolitical instability wars, blockades, plunging oil, global equities shake, ultra-high net worth individuals look at their brokerage statements, see millions wiped out in a single week, and experience a sudden wave of caution.
Vibe shifts.
Exactly, the vibe shifts. They pull back on the extra watch or the third handbag.
So the wealth effect dictates that paper losses create real-world spending freezes.
Yep.
Add in the fact that wars disrupt international flights, and airport boutiques are massive revenue drivers for LVMH. And the miss makes a lot of sense.
It does.
But let's look at the flip side of the earnings paradox. The financial sector. The vibe out there is terrible, but Goldman Sachs just reported record equities trading revenue for the first quarter.
Massive numbers.
They absolutely crushed it, driving the firm to its second highest quarterly revenue ever.
Because volatility is a trader's best friend. When the market is chaotic, institutions are constantly buying, selling, and hedging. Goldman's trading desks thrive on that movement.
But here is the twist. Despite crushing estimates, despite posting its second highest revenue in the history of the firm, Goldman Sachs' stock is actually falling today.
Yeah, it dropped.
If a company breaks records and posts its second highest revenue ever, why on earth is the market punishing them? Is the market just completely irrational?
What's fascinating here is that the stock market is a forward-looking mechanism. It rarely rewards a company for what it just did. It prices a company based on what it is going to do next.
Right.
Investors look at that record trading revenue and realize it was driven by a geopolitical panic.
So they know trading revenue is episodic. It's a spike, not a trend.
Precisely. If Goldman's core, repeatable business like mergers and acquisitions or steady wealth management isn't showing the same explosive, sustainable growth, Wall Street worries this quarter is the absolute peak.
It was all downhill from here.
In their eyes, yeah. They sell the stock because they don't see how Goldman beats this record next quarter without another war. It is the curse of setting the bar too high.
Okay, so old guard luxury pauses because of bad vibes, and old guard finance drops because their good news isn't repeatable. But if these legacy sectors are struggling, why is the broader U.S. stock market experiencing a massive bounce-back rally today?
Because tech and software are basically putting the entire market on their shoulders.
Software stocks are defying gravity right now. Oracle popped nearly 12% today.
Yeah, 12%.
This is a company that had lost over a fifth of its value earlier this year because everyone was terrified AI was going to completely disrupt their legacy database business.
Oracle is a perfect case study in legacy adaptation. I mean, 6 months ago, the narrative was that generative AI would render traditional database management obsolete.
Right. Everyone thought they were dead.
But Oracle proved they could integrate AI into their existing systems and actually charge a premium for it.
Yeah.
A 12% pop in a single day for a legacy giant is Wall Street breathing a massive sigh of relief.
They proved they aren't a dinosaur. They are just a very large lizard that learned how to use AI.
That's one way to put it.
And speaking of legacy giants coming back from the dead, look at Intel. They are on a historic 9-day winning streak, up an incredible 58% over that run. 58%.
It is staggering for a blue chip stock. And this is being entirely fueled by new deals with Google and Elon Musk.
Wow.
Intel has struggled for years to reclaim its manufacturing edge from overseas competitors. These deals signal that massive, cutting-edge tech players are finally trusting Intel's domestic foundries to physically manufacture the next generation of chips.
That is a massive vote of confidence in U.S.-based chip manufacturing.
Absolutely.
But here's where it gets really interesting. The AI boom isn't just lifting boats. It's turning into a high-stakes game of corporate musical chairs.
Oh, for sure.
OpenAI is suddenly dancing with Amazon, leaving Microsoft scrambling. OpenAI just announced a brand new alliance with Amazon, and they explicitly stated that Microsoft limited their ability to reach clients.
Yeah, that was a shocking statement.
Is this OpenAI reading the antitrust tea leaves? Or is Microsoft's Azure just hitting a physical limit on the compute they can provide?
It's likely a mix of both, and it represents a seismic shift. Microsoft and OpenAI were the golden couple of this revolution. Microsoft poured billions into them to secure exclusivity on the Azure cloud.
Right.
But as OpenAI scales its models, they are realizing that being tethered to a single cloud provider is a massive bottleneck. Amazon Web Services is still the largest cloud infrastructure on the planet.
So it's just about scale.
Yeah. By allying with Amazon, OpenAI is ruthlessly prioritizing distribution and compute power over loyalty.
It is a brutal pivot. Thanks for the billions, Microsoft, but we need more servers.
Basically. Meanwhile, Alphabet is weaponizing its own AI, expanding its AI-powered Google Finance product to a worldwide audience. They are letting algorithms evaluate market data for the everyday user.
This completely alters the retail investing landscape. It democratizes the kind of real-time data synthesis that, frankly, used to require a $30,000 Bloomberg terminal. All of this is totally reshuffling the tech hierarchy. Right now, the briefing notes that NVIDIA, Microsoft, and Taiwan Semiconductor Manufacturing TSMC are viewed by the market as better investment opportunities than Apple.
Yep.
Apple, the undisputed king of the mountain, is slipping behind.
It comes down to growth rates versus valuations. Apple is an incredible company, but it is primarily a hardware business tethered to the iPhone upgrade cycle, which has naturally slowed down.
Right. People aren't upgrading every year anymore.
Exactly. NVIDIA, Microsoft, and TSMC are the picks, shovels, and raw infrastructure of the AI gold rush. They are growing at rates that a mature hardware company simply cannot match, making them far more attractive to institutional capital.
You are only as good as your next growth cycle. But, the market for all its data isn't always right about tech.
Not at all.
Algorithms and institutions might be driving tech up, but they can also completely misread complex tech announcements. And that creates massive hidden opportunities.
This is perhaps the most vital lesson for anyone navigating modern markets. Information overload frequently leads to algorithmic mistakes.
Let's look at the cybersecurity sector. The entire sector suffered a broad sell-off recently following an announcement from Anthropic, which is one of the top-tier AI research labs, about a new initiative called Project Glasswing.
Right.
The headline hits the wire, and boom, cybersecurity stocks tank. But the briefing notes the market is completely misreading this news. This initiative actually benefits launch partners like CrowdStrike, Palo Alto Networks, and Cisco.
To understand this, you have to understand the mechanics of a flash sell-off.
Okay.
The market is driven by trading algorithms designed to scan press releases for keywords. The bots see Anthropic, they see new security architecture, and the algorithm's instant reaction is,
Oh, this AI replaces legacy security.
exactly, sell CrowdStrike. It triggers an immediate cascading sell-off before a human has even finished reading the first paragraph.
But how does Glasswing actually work? Because once human analysts dug into the technical documentation, the narrative flipped.
Glasswing isn't a replacement for cybersecurity platforms. It acts as an integration layer, an API. It essentially feeds massive amounts of advanced threat detection data into platforms like CrowdStrike at unprecedented speeds.
Oh, so it's a tool for them.
Right, it doesn't replace the guard at the door. It gives the guard a superpower. It makes CrowdStrike exponentially more effective and sticky for clients.
So what does this all mean for the average investor? If multi-billion-dollar institutional funds with endless data can completely misunderstand Project Glasswing and trigger a sell-off, how are we supposed to keep up?
Your greatest advantage in this market is patience. The algorithms trade on pure impulse. You have the luxury of trading on comprehension.
That makes sense.
When you see a massive sector-wide drop based on a highly complex tech announcement, that is the exact moment to pull up the technical documentation. If you can spot the market's misinterpretation before the humans correct the algorithms, you capture the upside.
It really pays to read the fine print. Let's do a quick roundup of a few other companies finding immense success by ignoring the macro chaos entirely and building impenetrable moats. First up, Revolution Medicines. They just succeeded in a late-stage trial for a potential breakthrough pancreatic cancer drug.
Pancreatic cancer is notorious for having a dense tumor microenvironment that makes it incredibly difficult for traditional drugs to penetrate.
Right.
If Revolution Medicines has actually cracked the biology on this, they have established a biological moat. That is the definition of idiosyncratic growth. The biology of a cancer cell does not care if the Strait of Hormuz is open or closed.
Biological moats are completely insulated from geopolitics. But you can also build a physical moat. Delta Airlines just unveiled its first new Delta One suite, pouring massive capital into heating up the premium cabin arms race.
It's a fascinating contrast to the luxury handbag pause we talked about earlier.
Yeah.
While high-end retail might stall due to the wealth effect, the economics of airlines dictate a relentless focus on premium real estate. The front 10% of an airplane often generates up to 70% of the flight's profit margin.
70%.
Yeah. Airlines use business and first-class cabins to subsidize the rest of the plane. By building ultra-luxurious, isolated suites, Delta is aggressively defending its highest margin demographic against international competitors.
Yeah. Finally, we have Ineos Automotive. They're a startup backed by a knighted billionaire and a soccer mogul, and they are aiming to completely rekindle the rugged analog SUV market.
They are zigging while the entire industry zags.
Big time.
The global automotive trend is sleek, autonomous electric vehicles that feel like an iPad on wheels. Ineos is betting there is a massive, highly profitable demographic of drivers who actively hate that trend.
Me being one of them.
Right. They want mechanical buttons, rugged capability, and a vehicle they can actually repair. It's an analog rebellion in a digital market.
It is a bold bet on a highly specific demographic. So let's take a breath and synthesize the massive amount of ground we've covered today.
We covered a lot.
We started by mapping out the sheer gravity of the U.S.-Iran conflict. We saw how a blockade in the Middle East forces bond yields lower and pushes the global supply chain like a waterbed, driving up natural gas prices just as California's solar grid goes dark.
Then we waded into the earnings paradox, realizing that LVMH suffers when paper wealth drops, and Goldman Sachs gets punished for posting record trading revenue because Wall Street knows chaos isn't a sustainable business model.
And we watched the tech sector defy gravity entirely. Intel rocketing 58% on new foundry trust, Oracle proving legacy tech can adapt, and OpenAI ruthlessly abandoning Microsoft for Amazon to feed its insatiable need for computing power.
The core takeaway for you, as someone navigating this environment, is that staying well-informed requires looking past the immediate emotional reactions of the market. You have to ignore the algorithmic panic over Anthropic's new API or the knee-jerk drop in a bank's stock and focus relentlessly on the actual mechanics of what these companies are building.
You have to be the one who reads past the headline. But before we go, I want to leave you with a thought to chew on. Okay. Today, we looked at how AI is causing massive realignments in the stock market, from the hardware level at Intel to the software integrations at CrowdStrike. But with Alphabet rolling out AI-powered Google Finance worldwide and AI evaluating market data in real time.
It changes everything.
Right. It leaves you wondering, how long until these AI systems aren't just the companies we're investing in, but the ones actually making the trades for us? And when an AI misreads another AI's announcement, what happens to the market then?
We could be looking at flash crashes driven entirely by machines misunderstanding each other at the speed of light.
It's a brave new world out there, and the rules are being rewritten daily. Keep reading the fine print, keep questioning the headlines, and keep looking for the hidden mechanics no one else sees until the next deep dive. Take care.